Chopra here, and I'm with Akhil Mair from our mortgage broker. And we're really lucky to have him with me here today, obviously virtually. Akhil is very much a big part of the J6 community. And today I thought I'll take the opportunity to discuss with him the mortgage market. It's been, I think, just 3 weeks or thereabouts when the mortgage payment holiday was announced. What I would like to discuss with Akhil today is life before COVID-19, while we are in this lockdown, and then post it. Obviously, he's got a crystal ball. So Akhil, would you like to firstly introduce yourself, and then we can talk through some of the questions?
Thanks, Manni. Hi all. I'm a mortgage broker and managing director of a brokerage called Our Mortgage Broker. We are an independent and have access to nearly 100 mortgage banks and lenders out there in the market. Just a bit of context about who I am and what I do. So I haven't just been in the game for a couple of years. I've been in banking and finance since 2002. I've done numerous roles within the bank, with HBOS in particularly for about 10 years, and then 3 years with Lloyds when the merger happened in 2009. Now, what I've seen and what how we've come out on the back end is we've seen peaks and troughs in markets. We've seen market consensus, we've had bank recessions and so on. But what we've done is we've actually realigned our plans and our agenda going forward. So I think whether it's the pandemic that we're going through now with coronavirus, it's how we adapt to change. And I think change is good, and I think it makes us stronger. And usually the strong always come out on the other end. Types of services that we offer at Mortgage Broker. So we're a multidisciplinary business, so we can help a range of clients. So whether you're setting out in property to buy your first buy-to-let or a first-time buyer, we can help. If you are a commercial landlord where you're looking to buy retail with, for example, flats above, so it's called semi-commercial, we can help. And if you're on the other end of the market where you are a property developer, we can arrange development finance, which includes refurbishment finance and short-term finance, also known as bridging finance.
Brilliant. Well, thanks for that, Akhil. So as you can see, Akhil is very much a one-stop shop. Akhil, what I'd like to start off by asking you is just give a very brief synopsis of what it was like not so long ago, but it seems like 100 years ago now, pre-COVID.
Okay, so pre-COVID, we had the whole Brexit malarkey. It went on for about 3 years. 2020 started off actually really good. So Boris was elected. We agreed to come out of Europe by 31st of January 2020, which was great. When that happened, we saw inquiries spike. We had auction houses fuller than they've ever been. We had great consensus, a lot of positivity in the market. Oops, sorry, let me decline these calls. Bear with me. Give me 1 second, Manni. Sorry, I'm just going to, give me 1 second. I'm just going to reject all my calls.
Take your time.
I'm just going to divert them. Bear with me.
Okay, no problem.
Okay. So I'm back, sorry. Okay, so yes, as I was saying, so Brexit came, it was agreed 31st of January, we're going to be out, which is amazing. As I said, the auction house rooms were full, the consensus in the market was great. We had loads of new inquiries, so people that were sitting on the fence during Brexit, or they were double-minded, they came forward and said, actually, we want to move ahead with the purchase or the refinance, or we want to arrange finance for a site that we purchased in year 2010, for example. Now, what we've seen since is between Brexit, 31st of Jan, and COVID during some part of March, we had a great opportunity for clients to raise finance. We had lenders coming into the market offering amazing products never seen before. The loan to values were amazing. The types of product, the types of criteria, and the types of clients that they were invited to take up borrowing was amazing. So it was great from a client's perspective, from a broker's perspective, because we had lots of opportunity and we could actually cherry pick the deals that we wanted to. So it was nice. It was nice to see that we can make lenders battle off with one another, because what we found was you'll have lender X reduce their rates and provide free legals and free valuations. Then the day later, you'll have lender Y doing the same or even better. So it was great from a client's perspective. So it was really, really good. And then unfortunately, then COVID turned up. It's been lingering apparently since November and December. I don't know where it started, whether it was US or whether it's China, who knows. So COVID's come in, and what I would say is, I think the market has reacted. And what I mean by that is, when we have any issue in life, just generally, we react. And what happens is we start we start thinking worst case and we contract from the market or we contract from our plans. What I found was in the last 2 weeks in particular, the vast amount of lenders pulled out of the mortgage market, and they either pulled out of new applications or they reduced their loan to values, or both. Now, what I found was, and what we were expecting anyway, was a retraction and reaction to the market, because the government announced that they were going to allow for holiday payments. So lenders were inundated with calls to say, can we have a 3-month break, and so on. So, and then the other thing was that you've got banks and then you've got lenders that take up securitization. So their funds get dried up, or the funding lines get more expensive, or the spreads get more weaker. So there's not enough margin for it. So you've got to understand from the lender's perspective that they've got to adapt to the local government, or so the central government news of allowing for holidays.
Yeah.
They're inundated with calls, and then they may have had to potentially lay off staff. So hence why they couldn't accept new applications, because it would just be chaos, right?
But considering, to be fair, they've done amazing, John. Going through from what you've just said, there's a lot to deal with in a very, very short space of time.
I totally agree. And I think the last 2 weeks has been about lenders reacting, taking on those inquiries where people need to take holiday payments, answer those existing client banks questions. And what we've seen just this week only, so where are we now? We're at the 9th of April. So the beginning of this week, I've seen lenders come back into the market. I've seen lenders put on new products. I've seen lenders increase their loan to values, which is great to see. So I think we're coming out of that sort of reaction side, and we're now seeing lenders saying that, okay, we've now secured the holiday payments. We've got to the peak of those numbers. We know where we are with staffing levels. We've now adapted to working remotely, and they've got tech now in place. They've got their processes in place, because remember, no one's ever done this. No bank have turned staff away to work from home. We've never had surveyors working from home and doing desktop hours and so on for lenders. So I think the last 2 weeks, as I said, has been more of a reaction. I think people are adjusted to how to work remotely, whether it's from your home office and so on. So I think we've seen that, and I think we're coming to the back end of that. And I think this week and going forward in the next couple of weeks, you're going to see lenders coming back onto the market. I think they're going to readjust their product suites by way of loan to values, their criteria, who fits, who doesn't fit, loan sizes and so on. But I think the consensus is that lenders will coming back to the market. You may see a little adjustment in loan to values and interest rates. So we've had two huge reductions in a short space of time in March, from 0.75 to 0.1. So lenders have had to factor that cost in as well into their borrowing, and obviously they've got to look after their savers as well. So those depositors, they've got to look after those. If you are on a tracker rate, you've probably seen a reduction in your mortgage payments over the last in this month or in the next month coming up in May. What else have I seen with the market? I've seen lenders increase their fixed rates. So going back to their funding lines, they have actually increased their fixed rates by a small margin.
But having said that, what do you mean, the percentage?
Yeah. So, for example, you might have seen a 1.99 2-year fixed for a residential mortgage, and it may now be 2.1. So it might be a small increment change, but in the grand scheme of things, it's not going to be a huge impact on clients. It is a small increase, but you've just got to factor that into your costs, your income, your expenditure. So that's what we do at our mortgage broker. So even prior to this pandemic, we always give the clients a couple of options. So it's not client wants X and we provide them with the X. We will always do the X, but we want to provide them with option B and option C. So no matter where you are, so whether you're buying your first home or buying a buy to let or looking for a revaluation or a refinance because you've done some value add to a property, what happens if the valuer doesn't agree with your valuation? So we've had times where not every valuation comes in on point. Some valuers have had to reduce the open market value, the 180-day value, the 90-day values, and the rental market values as well. So how do we as brokers help our clients ultimately get the right finance is what we do. So here at our mortgage broker, we've got a vast team that we work with. So we've got an internal team of experienced brokers, and then we've got an external team of the power team. And what we do is within that power team, we've got solicitors, conveyancers, architects, accountants, and so on. And these are people that we refer to because we want our clients to win. If our clients don't win, we don't win. So it's a win-win. And we don't call our clients clients. They're more like family. They're more like friends to us. So it's doing the right thing. And if it's not the right thing for them today, we tell them. We want to be there for the long game. We're there for the long game. And as I said, my experience spans back from 2002. So a lot of my clients are introduced to me from people that I met in 2002. So from a business standpoint, nothing's really affected my business because I'm blessed to have great introducers, a great professional network around me, and business associates that always refer into our mortgage broker. We haven't really taken a hit on inquiries, to be honest with you. So we are fortunate from that perspective, a long way that continue. But all I would say is the market, I think we've gone through the reaction point. I think we're now coming out of that, and we're going to see lenders now adapting to those changes and wanting your business.
Brilliant. So that was a fantastic synopsis. And I think really I take a positive spin from this because, as you said, they've adapted. They've had to obviously reduce some of their rates and things, but we can understand why now, because obviously their cost of borrowing has obviously changed and their factors have changed and parameters have changed. So they've had to now pass that on. So
Yes.
it's good to know as well that some of them have also passed on the reduced interest rate benefit to the clients, hopefully from this month going forward. In the immediate future, obviously, you will see a slight reduction of new applications, I will presume, because obviously there's no viewings been happening for the last 3 or 4 weeks, and they might not happen for the next few weeks or whatever. We don't know exactly what the timeline is, but that 6-8 weeks of lull, of complete lockdown, will probably obviously cause a backlog. So people who were meant to or still want to move will want to do that, but it might be few months down the road. So I think you probably have a bit of lull period, but then during that lull, you might have refinancing and all sorts of other activity going on there.
Yeah. So great point, Manny. What I would say about valuations, it is quite a hot topic at the moment. And yes, RIC surveyors can't go out to properties for the obvious reasons. However, lenders are adjusting to that model. And if they are able to take up AVMs, automated valuation models, or desktop valuations, they are doing that. So sometimes not every property needs to have a human going to the property. It depends on the scenario. So if somebody is looking to buy a property or refinance a property, I would definitely suggest contacting us, because we're currently helping clients with purchasing a bridge, and they're doing a desktop valuation on it. We're doing a couple of buy-to-lets at the moment where they're doing a desktop valuation. These are remortgages, and we're doing a HMO at the moment as well, where they are actually doing everything, all the underwriting subject to offer. So we can it's still business as usual. If ultimately they do need a human to go and do an inspection on a property, they will leave that to the last minute. So the beauty is that everything else will get done subject to valuation. That's the worst case. But if they can carry out a desktop valuation, that would be great as well. So I speak to constantly a lot of the valuer panels like VAS, like Alliard, like Connells, like Enact as well. So there's numerous valuers that we're in constant dialogue with to understand what the parameters are, who's doing what, and then ultimately we share that with our clients. So it's nice little heads ups basically.
Yeah, I mean, we've had we've actually been quite lucky with one of our sites that we are potentially looking to buy, and it had a set of garages. So obviously there's no internal viewing. So we were lucky that the valuer happened to be local to the site, and very happy to go in and view it and do a valuation. And we're expecting the valuation report next week. So, that's just the way it happened to be. But so I know that they are going ahead with some of them where it's possible, depending on location and physical access and all that sort of stuff. So really, my next and potentially last question is, where now? I mean, there will be a bit of a dynamic change within supply and demand and all that. So post-COVID, whenever that is, June, July, August, whenever that is, where do you see the mortgage, the lender market going, and what are the positives and not so positives that we can look forward to?
Okay. What I would say is, I think no one's got the crystal ball. No one knows when we're exactly going to come out of this, which is a shame because I want my kids to go back to school. So that'd be great if they can go back to school. That. So that would be great if I knew. That'd be amazing. But they're happy at home. They're playing cricket right now, which is great. But we don't know. What I would say is we don't know when we're going to come out of this. But what we do know is what we can do within our own businesses. So why wait for things to change or give us a heads up that we can go to the gyms, or we can do this, not that I go to the gym, but we can do XXX. Now, but what I would say is we don't know what's going to happen or when it's going to happen, but we know how we can adjust to the times that we're in today. Now, what I would say is and what I've done on another other forums is review your business plans, review the way you work, review the way you assess deals, review the way that you purchase property, because I think going forward you may see more of these sort of calls, more virtual viewings. You may see lenders, solicitors, valuers carrying out more AVMs, more desktop valuations, because it makes the process more seamless. It speeds up the process. Because they're going to say, well, you managed to do it through COVID. Why can't we do it now post-COVID? So what I would say is, for those looking for deals, carry on looking for deals. You know, estate agents, then I know their doors are not open, but they're on the other end of phones, they're on the other end of emails. Let them know that you're in the market to buy property. Let them know you're looking for a buy-to-let. You're looking for up to £500,000. You know, you've got a dip in place. Contact us. We'll arrange the dip. We'll communicate that with the estate agent so they know you're a serious buyer. And we do that every day of the week. So I would say is remain positive, remain upbeat, but don't stop, because if you stop, you're going to come out of momentum. And I think we've just come out of Brexit. That really, really knocked us for six, a lot of us for six over the last 3 years. But look what happened between January and prior to March. Everyone was optimistic. Everyone was boom, boom, boom. But I would say remain optimistic. We've got lenders doing amazing stuff. They've now, as I said, they've reacted. They're now coming back onto the market. And because we get inundated with emails and inquiries and updates from lenders and BDMs. So we're in the know-how, usually sort of 2-3 days prior to it happening. So that's good for our perspective. And then what I do is share that with my clients, because I work for my client. I don't work for the lender. So yeah, I would say review your business plans, review the way you work. I think we are going to have some adjustments going forward. I think lenders are going to factor in, there could be another pandemic tomorrow, because they are going to think of these things. So I think when for example, you're doing a development, you may need to adjust your GDV figures, because I think GDVs are, a developer always thinks of GDVs up here, if not here. So I think you need to factor in those GDVs. I think you may still need to factor in the revaluations. I think you need to factor in the build costs, the material costs, and the time span that it takes to do the build, as well as a sale, for example, if it is a sale. So I think it's key that you reevaluate all your methods of working, including the actual deal process and the GDVs, because everyone thinks the GDVs here, but ultimately you're in the hands sometimes of the monitoring surveyor and the valuation officer. Unless you've got comparables or local comparables that really stack up and meet the checklist for the lender and the valuer, you're probably not going to get the valuations that you want. So I would definitely say, remember that you make money on day one, i.e. when you purchase the property, not on the GDV. So if you're I always say to my clients, if you're double-minded or you think the numbers don't stack, or it's not just right there where you are, walk away. Just walk away, or go in and give an offer that's below.
Or lower offer, yeah, absolutely.
There's no harm. There's no harm. They're either going to counter you, or they're going to say sorry, and then you just walk away, because the last thing you want to do is get in bed with a lender that you're over leveraged. Your GDVs are a tank at the back end.
Yeah, the high GDV squeeze margins,
and then you can't resell it. And then you're stuck with this lovely new block of flats, for example, but there's no real value in it. And then you've got sweat equity as well. So there's lots of things you need to factor in. And with anything, I always give our clients plan B and plan C. And if you haven't done that in the past, even in your own deal appraisals, please, please, please do so. Because if this doesn't change the way you work, then I don't think it ever will.
Absolutely. Last question from me personally, I think, is we potentially have access to some distressed deals coming through in the next weeks or months. What is the appetite, or what will be the appetite in your view on funding these, and the typical loan to values and things like that?
Okay, so yes, I think you're going to see, as you're always in the market, Manni, looking for great deals, and I think you will come across these distressed sellers, whether they're looking to retire or they've had enough of the property gain, or for whatever reason is, you are going to come up and meet these great opportunities. What I would say is that's the best opportunity to get a great deal or get a great bargain. So see how much you can buy it for below market value, or potentially do an agreement where it's a lease option. You purchase it with a delayed completion. Now is a great time to say, okay, Mr. Smith, I'll buy it for 100,000, but I'm going to complete in January 2021.
Yeah.
Because that way, hopefully the market would have adapted, the price would have gone back to where it should have. Maybe we are seeing a correction in the property market. Who knows?
Yeah.
But you've got to just understand where the lender is, because especially if you're looking to borrow monies, and it depends what type of funding you're looking for. Are you looking at 75% or are you looking at 60% loan to value? So it depends where you are on the funding line. So if you are 90% of the clients that I speak to, they always want the top dollar. So they're always looking for 75, if not 80 and 85% loan to value, which is good. It's fair enough. It's part of their business model. But what I would say is that when you are looking for these deals, either delay the completion, but get it in writing that you agree the purchase price today. Speak to people like myself. There might be a great deal that's open for you to carry out the purchase, the exchange and completion now as we speak. Or sometimes it might be a deal that you actually have the deal locally with the client, and then you come to us on the back end to say, now we've got this great deal. How can we structure the finance on this deal? So whether it's short term or it's buy to let or it's development finance and so on. So I would say is work with these people, explain to them the situation, where you are, what type of funding you're requiring, and meet them in the middle, or have that sort of agreement. So there's going to be great opportunity for everyone out there, I believe.
Brilliant. So I think I'm just going to sort of summarize it from my point of view, and what the discussion I've had with you. I think it just boils down to three things: review,
Yeah.
reevaluate all your, for me, I know personally, I'm going to be re-looking at my deal appraisal and maybe making it even more tighter, doing even more comps, lowering loan to values, all that sort of stuff, and raise capital, because I think coming out of it, there will be distressed properties, there will be opportunities, and cash is king. So I think on that note, I'd like to say a massive thank you to giving up your time. And obviously, you've got two lovely boys back home who probably want to spend a quality time with you, but instead you came here and did this talk with me. So I really do appreciate you coming, and enjoy the rest of your Easter weekend. And speak to you soon.
Thanks, Manny. All the best.
Cheers. Bye.
Bye.